2,000 years ago, a Roman centurion was paid 38 and a half ounces of gold a year. In 2024, two men did the obvious thing with that number. Claude Erb, a former commodities fund manager, and Campbell Harvey, professor of finance at Duke. And before you file Harvey under academic with an opinion, he edited the Journal of Finance, the leading journal in the field, for 6 years. And he was president of the American Finance Association. His own words, on his own faculty page. These aren't cranks. They're the people other economists check their work against. So they took 38 and a half ounces, multiplied by the price of gold, and got $86,342. Then they looked up what the United States Army pays a captain with 6 years in, $85,594. 2,000 years apart. Same rank, roughly, same pay, almost exactly. That is the single most quoted piece of evidence in the entire case for gold, and it is genuinely beautiful. It's also the setup for a trap, and the people who said it are the same two men. Here's the very next sentence of that paragraph, the one almost nobody quotes. A Roman legionary was paid the equivalent of 2.31 ounces of gold, about $5,000 today. And a U.S. Army private with 6 years in makes $24,206, which is 10.8 ounces. Same Army, same 2,000 years. The rank above holds almost exactly. The rank below is out by a factor of nearly 5. Erb and Harvey put the proof and the refutation in the same paragraph. The internet stopped reading after the captain. That's this whole video. Not whether gold holds its value, but what happens every single time somebody tries to prove that it does. Let's state the claim properly because it deserves better than a straw man. It goes like this: gold doesn't go up, the dollar goes down. The price on the screen isn't measuring gold. It's measuring the thing you're measuring gold with. An ounce bought a good toga in Rome. An ounce bought a good suit in 1900. An ounce buys a good suit now. Empires fell, currencies died, and the metal just sat there being worth a suit. And it's seductive for a reason. It's checkable, it's ancient, and gold is the only asset on Earth that nobody can decide to make more of. We're going to do this in 4 parts. First, we test that claim. Properly, 3 ways. Then we prosecute gold. Then we defend it, just as hard. And then we get out of the way, because the last part is yours. Part 1. 3 tests, 2 of them break the claim. The third one explains everything. And then, once we know what gold isn't, we'll look at what actually moves the price. Test 1. The price history. Every argument for gold starts with the same chart. A century where the line barely moves. And the line is real, in the sense that it's the price the government promised to pay. Officially, gold was $20.67 an ounce, right up until 1933. Then ask where that number came from. Congress never set a price for gold. It set a weight. The Coinage Act of 1834 says a $10 gold piece shall contain 232 grains of pure gold. A tweak 3 years later made it 232.2. And in 1900, the Gold Standard Act wrote it out in full. The dollar consisting of 25 and 8/10 grains of gold, 9/10 fine, shall be the standard unit of value. Do the division, a troy ounce is 480 grains, and you get $20.67. That is where the number comes from. It was never a market price. It was a definition, written in grains, which is the whole trick. Saying gold held its value in dollars was saying an ounce of gold was worth an ounce of gold. It isn't evidence. It's a circle. And here's what that flat line hides. It isn't even continuous. In December 1861, with the Civil War starting, the Treasury and the banks stopped paying gold altogether. The government printed paper instead, in greenbacks. And for the next 17 years, the dollar floated. At the bottom, in July 1864, a paper dollar was worth about 39 cents in gold. 61% gone. Payment in gold didn't resume until the 1st of January 1879. And that's the part that matters for the chart. In the money Americans were actually spending, an ounce of gold cost around $53 that summer. Not 2067. The official price never moved a cent. The real one had nearly tripled. So the great unbroken century of stability has a 17-year hole in it. The line looks flat because it's the promise, not the price. And that stretch is usually drawn as if it never happened. Then 1933, Roosevelt bans private ownership and the government buys everyone's gold at $20.67. The next year, the Gold Reserve Act revalues gold to $35, which means the dollar was devalued against gold by about 41% the year after the citizens handed theirs in. Hold on to that. It comes back. And $35 is where gold stayed. Through the war, through Bretton Woods, the post-war system that pegged world currencies to the dollar and the dollar to gold. Until the 15th of August, 1971, when Nixon closed the window and gold was finally allowed to float. So here's the first finding. Gold has traded freely for 55 years. Everything before that is a number Congress wrote down. The flat line everybody shows you isn't stability, it's legislation. Test 2. Throw out the legislated years and test the claim on the only period where gold actually trades, the last 55. On the 21st of January 1980, gold hit $850 an ounce in London. Oil had quadrupled, inflation was running near 14%, and on that exact same day, silver peaked too. It was the top of the greatest gold mania in living memory. Now put yourself there. You believe the thesis. You believe gold holds its value. So you buy. Now let's not do what everyone does and jump straight to today. Let's walk it. Every year we ask one question. How much of your purchasing power is left? By the end of that same year, 1980, you're at 66%. 1990, 27. The year 2000, 15. The floor is 2001, 14%. You have lost 86% of what you put in, while the cost of everything you buy has doubled. Then gold starts running again, and this is the part that surprised us. 2011, gold is on every front page. It's the great commodity boom. Everyone says it's back. You're at 64%, 31 years in, and you're still down a third. 2020, 67. 2024, 76. Still not whole. And in plain dollars, none of this is obvious. Gold passes 850 in 2008, 28 years. It looks like you're back. You're not. $850 in 1980 buys, what about 3,600 buys today? To be genuinely back, gold had to clear that. It cleared it in September of 2025, 45 years. If you were 40 at that peak, believing the thesis, you were 85 before your gold was worth what you paid for it. And we should be fair because this is the worst case. You bought the exact top. Buy gold in a quiet year, and you're usually whole again inside 2 or 3. Buy at the 1980 average price rather than the peak, and you still waited 32 years. So the honest version isn't gold ruins you. It's that gold's damage is concentrated entirely in the moments when it's most convincing, which is a problem because nobody buys gold in a quiet year. And this isn't ancient history. Gold set an all-time record of $5,501 on the 29th of January this year. By the end of June, it closed at $4,026, nearly 27% in 5 months. We're not going to tell you what that means for next year. Nobody knows. We're telling you what a constant isn't. Test 3, and this is the one that changes the video. Because the suit thing is true. An ounce really has bought a decent suit for a very long time. So how does a claim survive 2 failed tests and still be right? Ask a different question. Not, does gold hold its value? Ask, why that object? Why is it always a suit? Because a suit is one of the very few things human beings never learn to make dramatically better. A Roman toga was weeks of hand spinning. A bespoke suit today is still dozens of hours of a skilled person's time. Its price tracks wages, not technology. Now run the same test against something we did get better at. Light. The economist William Nordhaus built the table nobody else bothered to build. How many hours of work it took to buy 1,000 lumen hours of light, right across 2 centuries. In 1800 with a tallow candle, 5 hours and 22 minutes. By 1900 with a carbon filament, 13 minutes. By 1992 with a compact fluorescent, 0.4 of a second. The same light for 45,000 times less human effort. Gold does not survive that comparison for a second. And it isn't just light. Clothing off the rack, computing, flying, American clothing prices fell in nearly every year of the 1990s. So here's the shape of it. Since 1970, 1 ounce of gold buys about 47 times more clothing than it did. Against a restaurant meal, the same food plus somebody to cook it and carry it, it buys only about 10 times more. Things machines make. Gold wins enormously. Things people still have to do. Gold barely moves. And that's the finding. Gold isn't a constant of value. It's roughly a constant of effort. And only when you zoom out far enough not to see anything else, which explains the suit. And it explains something less comfortable. The proof works right now because gold is expensive right now. Go back to the year 2000 when an ounce was $279 and an ounce bought a cheap off-the-rack suit and nothing else. Nobody was writing articles about the golden constant in 1999. The myth is loudest at the top. Which leaves the obvious question. If it isn't a constant, what moves it? 2 forces, and almost nobody names the second one correctly. Start with the floor. Gold has to be dug up, and that costs money. Miners report it as all-in sustaining cost. Everything it takes to produce an ounce and keep the mine running. Right now, the industry median is somewhere around $1,500 to $1,600 an ounce. Here's what's strange about that floor. It keeps rising, and it rises for a reason nobody expected. A century ago, good gold ore ran 4 to 7 grams per ton of rock. Today, plenty of open-pit mines are working 1 to 2 grams. Head grades have fallen more than 13% since 2010 alone. Put that in physical terms, because it's easier to feel. A century ago, an ounce of gold came out of roughly 6 tons of rock. Today, it's closer to 21. Same ounce. 3 times the mountain. Meanwhile, the technology got extraordinary. Cyanide leaching, 400-ton haul trucks, automation, sensors. And it still isn't enough. The all-in cost of producing an ounce has risen by about half in 6 years. The rock is getting poorer, faster than the machines are getting better. That's the part people miss. Mining gold isn't a manufacturing problem that technology slowly solves. It's a depleting one. You dig the easy gold first. Every ounce you take makes the next ounce harder. You run to stay still and you lose ground, which is exactly why gold tracks human effort and a light bulb doesn't. A lumen is a lumen. Technology only had to get better. An ounce of gold has to be taken out of a planet that's already been picked over. Now the second force. Above that floor sits everything else. At today's prices, roughly 60% of what you pay for gold is not the cost of producing it. It's a premium. And the premium moves with one number, the real interest rate, what a safe bond pays you after inflation eats its share. Gold pays you nothing, ever. So when bonds pay a solid real return, holding gold is expensive. You're giving something up. When real rates go to 0 or below, gold's 0 suddenly looks competitive. And between 2003 and 2021, that worked almost mechanically. The real price of gold and the real yield moved against each other with a correlation of minus 0.8. Real rates explained about 2/3 of everything gold did. For 20 years, that was the whole story. And then, in 2022, it stopped. Real yields roughly quadrupled. The exact conditions under which gold is supposed to fall. And gold nearly doubled instead. The engine that had explained 2 decades simply quit. Hold on to that, because it's the same year something else started. We'll come back to it. And notice what just happened. We've now explained what actually sets the price of gold, a floor and a premium. And we never once needed inflation. Which brings us to the man who named this whole idea. In 1977, an economist called Roy Jastrom published a book on gold's purchasing power across 4 centuries. It was titled The Golden Constant. Everyone in gold quotes the title. Almost nobody quotes what he concluded. According to the reviews of that book, Jastrom found gold to be a poor hedge against serious inflation and at its best in deflation when prices are falling. The founding text of The Golden Constant says the opposite of what it's used to say. Part 2, we prosecute it. First charge. If gold isn't a constant and isn't an inflation hedge, what has it actually done for the people who held it? Take $100 in 1928 and hold gold until today. Adjusted for inflation, you'd have about $1,100. Same $100 in American stocks, dividends reinvested, just over $61,000. 55 times. not 55%. And the inflation defense doesn't survive contact either. Gold beat inflation in 43% of calendar years since 1928. Stocks, 68. Over rolling 10-year stretches, gold beat inflation 46% of the time. Stocks, 88. Stretch it to 20 years, and it gets worse. Across every 20-year window since 1928, American stocks beat inflation 100% of the time. Gold managed 58. A hedge against inflation that fails more often than a coin flip is not a hedge. It's a hope. Now the part that explains why. Break down that stock return. 6.4% a year after inflation, of which only about 3.1 came from the share price going up. The rest, more than half of the whole thing, came from cash the businesses actually paid out. And that cash wasn't static. Real dividends grew almost sevenfold. Now break down gold's. 2.5% a year after inflation, of which the amount produced by the ounce itself is zero. Every cent came from somebody agreeing to pay more for the identical object. An ounce of gold in 2026 produces exactly what an ounce produced in 1928. Nothing. That's not an insult. It's the specification, and the meter runs the whole time. A vault costs money, insurance costs money. There's a spread every time you buy and sell. Stocks pay you to wait. Gold charges you. Second charge, and this one goes after gold's best line, the one that survives every other argument. The line is, nobody can take it from you. No default, no printing press, no keystroke. It's the last asset outside the system. Remember 1933. On the 5th of April 1933, Franklin Roosevelt signed Executive Order 6102. Its title is Forbidding the Hoarding of Gold Coin, Gold Bullion, and Gold Certificates. Section 2. Every person in the United States is required to deliver by the 1st of May all gold coin, gold bullion, and gold certificates that they own to a Federal Reserve Bank. You could keep $100 worth and your collector's coins. That was the exemption. And Section 9 sets the penalty for keeping your own gold. $10,000 or 10 years in prison. Now put the two halves together because the sequence is the point. Citizens hand in their gold at $20.67. The following year, the government revalues gold to $35. Everybody was paid the price from before the devaluation. The state bought low from its own population at $20.67, and then sold high at $35. And there are two honest ways to say what just happened, which is why people argue about it. Gold went up 69% in dollars. The dollar went down 41% in gold. Same event, both true, percentages just aren't symmetrical. Either way, buy low, sell high. It is the oldest trade in the world. It's just that this time it was run by the only player at the table who also gets to write the price. And that isn't a conspiracy theory. It's the Gold Reserve Act. So the strongest argument for gold has a documented counterexample in the largest democracy on Earth, in peacetime, within living memory of people still alive. Gold can't be inflated away. It absolutely can be taken. The property that makes it safe from a central bank does not make it safe from a government. Those are different institutions, and only one of them writes criminal law. Third charge, and it's the quietest one. It isn't about gold. It's about when people buy it. Gold is most persuasive when it's most expensive. That's not a coincidence, right? It's mechanical. The argument for gold is built out of recent performance. Nobody forwards you an article about the timeless store of value after it's fallen for a decade. Right now, gold is at or near the highest real price in its recorded history, above the inflation-adjusted 1980 peak. Which means the people finding this argument compelling today are finding it compelling after the move. That's exactly what happened to the class of January 1980. They weren't stupid. They had a coherent thesis, real inflation, and a chart that had gone straight up for a decade. Then they waited 45 years. And here's the thing that should give everyone pause, including us. Urban Harvey, the two we opened with, the journal editor and the fund manager, published a paper in 2013 saying gold's real price was historically high and should revert. They were early, or they were wrong, depending on how generous you feel. Which is the pattern, and it doesn't need a quote to make it. Gold is most attractive to buyers at exactly the moment its future returns are worst. We are not calling a top. We couldn't and we wouldn't. We're pointing at a pattern in the buyer, not a prediction about the price. Part 3. Now we defend it, and we defend it as hard as we just attacked it. First answer. And it goes straight at our best number, $61,000 versus $1,100. Remember where that came from? American stocks. And the 20th century American stock market is the single luckiest run of capital in recorded history. The definitive study of long-run global returns is Triumph of the Optimists. 16 Countries, 101 Years by Dimson, Marsh, and Staunton. It's the book that proves stocks win, and Russia isn't in it. Neither is China, because the study covers markets that existed for the whole period, and those two didn't. In 1917 and 1949, equity holders in those countries were wiped out, not down 80%, zero. Now, we're going to be straight with you because the alternative is doing exactly what we've spent this whole video criticizing. The authors know about this, and by the accounts of their work, they argue the effect is smaller than it sounds. The markets that vanished were a modest share of world capitalization at the time. That's a real answer, and it's probably right. But the defense doesn't need the global average to be wrong. It needs one state of the world, because a share is a claim. On a company, in a jurisdiction, under a government. Every one of those three can be canceled, and in the 20th century all three were, repeatedly. The gold those same families held did not go to zero. It went into a wall or across a border, and it still bought bread on the other side. So the prosecution's case is, in the world where everything works, gold costs you 55 times your money. The defense's case is, the entire point of gold is the other world. Second answer, and it turns our own weapon around. We've spent this video attacking gold's advocates for choosing convenient dates. That knife has two edges. Start in the year 2000 instead of 1928. Since then, gold has returned about 8.9% a year after inflation. American stocks, dividends included, 6.1. Over a quarter of a century, gold beat the stock market by nearly 3 points a year. And that's not a fluke of one window. Across every rolling 10-year stretch since 1928, gold beat stocks 29% of the time. Not never, close to a third, which sets up the strongest version of the defense. It goes, you've proven gold is volatile. So what? Stocks are volatile. Sometimes they're overpriced, sometimes they're cheap, and over time they track their fundamentals. Maybe gold is just an asset like any other. And its fundamental is the cost of pulling it out of the ground, which we've watched rise for a century. That's a serious argument, and it's the one we'd make if we were paid to. Gold does have a floor. It does mean revert. It is not an abstraction, and we ran the volatility ourselves. Since 1928, gold's year-to-year swings and the stock markets are the same size, 19.4% against 19.3%. Over the only stretch where gold actually floats, 1972 to today, gold is 44% more volatile than the stock market. From the metal that's supposed to be the stable one. Here's the best evidence for the defense, and it's brutal. In 2013, those two, the journal editor and the career commodities manager, used exactly this valuation logic. Real price high, expect reversion. Over the next 12 years, gold rose about 85% after inflation. The trade press headline when they published again read, "Proven wrong." The two people who built the tool for valuing gold could not use it. Which tells you something important. With gold, nobody can prove you're wrong. There's no earnings number to check you against. Third answer. If gold is a bad investment held by frightened people, somebody should tell the central banks. But you have to understand why a country owns gold. Because it isn't your reason. Every country keeps reserves, the national savings account, what you hold to defend your currency and pay your foreign bills when things go wrong. Dollars, euros, government bonds. And here's the thing about all of those. A dollar reserve is a claim on the United States. A euro reserve is a claim on Europe. A bond is a claim on whoever issued it. Every asset in that vault is underneath somebody else's promise. Gold is the only one that isn't. The single reserve asset that is nobody's liability. That's not a slogan, it's an accounting fact. And it's the entire reason it sits there, which stayed fairly abstract until 2022, when a major economy's foreign reserves were frozen by administrative decision. Not defaulted on, not devalued, switched off. And that's the year we told you to hold on to. The year the old engine quit, real yields climbing while gold climbed with them. Which isn't supposed to happen. This is what replaced it. Every other treasury on Earth ran the same thought. Reserves held inside somebody else's system aren't reserves. They're permissions. And you can watch them act on it. Between 2010 and 2021, central banks bought an average of 473 tons of gold a year. From 2022, that roughly doubled, over 1,000 tons a year, 3 years running. What happened next is just as informative, and most people skip it. 2025 came in at 863 tons. The first half of this year is slower again. The buying didn't stop, but it cooled as the price went up, which cuts both ways and we'll take both. They aren't zealots. They bought hard when gold was cheap and eased off when it got expensive. That's a portfolio decision, not a panic. And it means the best-informed buyers on Earth think the price matters. Even they won't pay anything for it. What they're buying, though, has never changed. Not a return, they know there isn't one. The one asset in the vault that doesn't depend on anybody keeping a promise, and you don't judge fire insurance by its rate of return. You judge it by whether it pays out in the one situation you bought it for. Part 4, and this one's short because it's not ours. Put the 2 columns up. It costs you 55 times your money. It fails against inflation more than half the time. It was seized once already. And against that, it survives the century that destroys everything else. It has beaten the stock market over the last quarter of a century, and the most sophisticated balance sheets on Earth are still buying it. Both columns are true. And they don't contradict each other, because they're not answering the same question. The prosecution answers, how do you get rich? The defense answers, how do you avoid losing everything? Gold fails the first one by construction. And it's the exact same property that makes it past the second. It doesn't participate in anything, so nothing can drag it down with it. Which finally answers the best objection to this whole video. That gold is just an asset that swings around its fundamentals. Like a stock, it's true. Both of them oscillate around a real anchor. The difference is what the anchor is doing. A share price swings around a business that grows, that keeps some of its profit and reinvests it. So the thing underneath gets bigger. Gold's price swings around the cost of extraction. And that cost only goes up because the ore keeps getting worse. So gold does have a growing fundamental. It's the growing difficulty of getting it. A company appreciates because it gets better at what it does. Gold appreciates because we get worse at obtaining it. Same volatility. Opposite destination. Which leaves you with the actual decision, and we're not going to make it for you, partly because it doesn't have one answer. It has 3 questions, and your answers won't match your neighbors. First, what's your horizon? Gold's constancy is real at the scale of millennia, and absent at the scale of a career. You are not going to live for 2,000 years. Your government might. Second, what odds do you put on the world where the promises stop being kept? Not 0. The 20th century says not 0. But that's the only world where this asset wins, and the premium you pay for it is everything human progress produces in the meantime. And third, the one we find hardest. If gold is the price of insurance, then its price is the market's estimate of how likely catastrophe is, and it is at or near the most expensive it has ever been in real terms. So either the world is more dangerous than it's ever been, or insurance is overpriced. Both are worth being uncomfortable about. Tell us in the comments which of those 3 you'd actually bet on. Not what gold is worth, what you think is coming. That's a more interesting argument. One last thread, because it's been running underneath this whole video. Everything gold costs comes back to the energy it takes to pull it out of the ground. And there's an old line that an economy is nothing but energy, transformed. In a coming video, we're going to study that idea properly. Everything here is education and entertainment. None of it is financial, investment, or legal advice. Go argue with us.